Okay, well, welcome everyone. Thank you for joining us today for our 2020 Compliance Supplement Addendum Update. My name is Angie Hillestead, and I am a partner in the National Assurance Office of Eide Bailey. And I'll do a quick round of introductions for our presenters today, and then we will get right into the material. So main presenters today are Sarah Kurtz, who is also a partner in the National Assurance Office, and Joy Feige, who is a partner in our Sioux Falls, South Dakota office and is the chair of our Single Audit Technical Issues Committee. So they're going to be talking about a few key topics today, primarily focusing on the 2020 Compliance Addendum that was released just before Christmas this past December. So a high-level summary of some of the most significant programs within the addendum. We'll talk a little bit about some of the audit impacts that really we're faced with now that the addendum is out, and we know as auditors what we're required to test for these programs. And then time permitting, we'll do some other high-level updates on single audit considerations. The last little thing I just wanted to mention is that our focus again is on kind of what was released in the Compliance Supplement Addendum. We, are all aware that there was another $900 billion coronavirus aid package that was passed by the president, or passed by the House and Senate and signed by the president early last week. We'll touch a little bit on some of the things that changed with that package, but our focus is really going to be on, at this time, what we know, and that's what's in the addendum. There's still a lot of moving pieces with that additional coronavirus aid. So we want to focus kind of on, where we're at now, and then as agencies provide additional information coming up here within the next few weeks, we'll provide updates as we have them. So with that, I'll turn it over to Sarah, and we thank you everyone for joining us today.
All right, thanks, Angie. Well, like Angie mentioned, so most of you have heard the good news that the Compliance Supplement Addendum has finally been released after waiting a few months for it to come out. So the Compliance Supplement Addendum is applicable for all of the June 30, 2020 audits that are in progress right now. We have included a link to the AICPA's website where they have broken out the Compliance Supplement Addendum by section. So that's there for an additional resource for you. The addendum includes 8 new COVID-funded programs, and then there were 6 pre-existing programs where there was additions for COVID-19 specific compliance requirements. In addition, the addendum also added a new reporting requirement to Part 3 of the Compliance Supplement, which is the General Compliance Supplement. That's going to be applicable to all programs and not necessarily just COVID programs. So we'll touch on that too. Auditors also need to be aware that this Compliance Supplement Addendum needs to be considered in conjunction with that 2020 Compliance Supplement. So the Part 3 addition that I want to talk about is specific to the new requirement in reporting for FFATA, which is the Federal Funding Accountability and Transparency Act. FFATA's been around, it's been a reporting requirement since 2010, but it hasn't been something that auditors have been required to test within the Compliance Supplement for several years. What FFATA does is it requires that any federal contracts, grants, loans, or other federal financial assistance to be made publicly available on the usaspending.gov website. So direct recipients of grants who make first-tier subawards of $25,000 or more are required to register in the FFATA reporting system, or FSRS, and report all of the sub-award data through it. So for example, let's say a large county received direct funding from a federal agency and sub-granted out $50,000 of funds to a local municipality. Since that county was a direct recipient and since they passed more than $25,000 through as a subgrant to the local municipality, that county would be required to complete the required FFATA reporting in the FSRS system. Now, while the audit requirement for FFATA was added to Part 3, the good news is that the addendum phases in the timing of when that is required to be tested by the auditors. So the requirement, the timing of it depends on the type of grant. So for the 6/30/2020 fiscal year ends, the FFATA testing is required for all COVID-19 programs included in the compliance supplement addendum where the reporting requirement has been marked as a Y or subject to audit. There is an exception to the coronavirus relief funds. FFATA does not apply to that program. Then for all audits of fiscal years ending after September 30th, 2020, the FFATA reporting is subject to audit for all major programs, regardless of whether or not COVID funding was involved. And that requirement would be applicable to any major program where Part 2 of the matrix says that reporting is subject to audit and marked with a yes. This slide here has the specific data elements that auditors are required to test. When auditors do their testing to make sure that we're having a complete population of all the subgrants that should have been reported in the system, auditors need to take a sample from all of the subgrants that were issued, obtain a copy of the grant, including any amendments or modifications, and then determine if that subaward is subject to testing. So they're going to be looking at to see what subawards were granted that were more than that $25,000 threshold, which would require the testing. From the sample of subawards tested, the elements that the auditors are going to look at are going to be the date on the subaward, was that, whether all of this information was appropriately entered into the FSRS system. So the date of the subaward, the DUNS number, the amount of the subaward. They're also required to look at the timing of when the information was reported. So as one thing to note though, so even though recipients, they go through and they report all of this data in the FSRS system, this system is only available to the recipients. And then the information in the system feeds into usaspending.gov. But auditors are going to need to access the FSRS system in order to test all of the required data elements, because all of this information is not publicly available on the usaspending.gov website. And so what that means is auditors are likely going to be asking all of the grantees for maybe screenshots or to maybe sit and do some sort of screen sharing while although the recipients use their login information into the FSRS website. The compliance supplement is very specific on what needs to be reported as a non-compliance finding, and they are very particular on all of the information that needs to be included as part of the context of that finding. So if any non-compliance was identified, so non-compliance could be anything from the required reporting didn't occur to maybe incorrect information was reported, or that the reports were not filed timely, all of that information needs to be included in the finding. And so there's a table at the bottom of this slide, and this is the recommended format to report the non-compliance findings. Now this came right from the addendum. It's recommended to be used, but it's not required. However, if a table format isn't used, all of the information included here still needs to be identified within the audit finding. And just as a reminder for the auditors listening in, when the data collection form is completed, and the auditors go and copy and paste the text of the finding into the data collection form, the data collection form only accepts text. So it's not going to accept the table format here. So an acceptable way to address this or get around this is to make a text note referring to the actual table in the report. So that's a brief summary of the FFATA reporting. This slide here is the new COVID-19 programs that are included in the addendum. So today we're going to focus on the 4 most significant programs, and those are the Coronavirus Relief Fund, or CRF, the Education Stabilization Fund, which that has 2 sections. So there's a section for called Education Stabilization Fund, and then a second section for Higher Education Emergency Relief Funds. And then we're going to wrap it up with a discussion on the Provider Relief Program. This right here is an excerpt from Part 2 of the matrix. So within the addendum, Part 2 includes a matrix for all of the new COVID-19 programs, as well as those programs that were added, that were updated to include COVID-19 specific compliance requirements. We included it here just as a reference. You can see everything that's been bolded is a new program, and it has new next to it. The programs that are not bolded are existing programs where COVID-19 requirements have been added. The yellow ones on here are the programs that we're going to talk about, and specifically the compliance requirements that are identified as being subject to audit. So the first program that we want to talk about is the Coronavirus Relief Fund, or CRF. The CRF funding was to cover necessary expenditures incurred due to the COVID-19 public health emergency. And while there's a broad range of allowable costs that could be considered necessary, the Treasury was clear that the funds could not be used to fill shortfalls in government revenue. To provide additional assistance on types of expenditures that would be considered necessary, the Treasury has provided additional resources on their website, including additional, there's additional program guidance, there's FAQs, and in fact, on the allowable cost side, Treasury has I believe it's up to 55 questions now in the FAQ relating to eligible expenditures. They also have FAQs related to the general administration of the funds. And one of the nice things that I like about the Compliance Supplement Addendum is that at the start of the Compliance Supplement, OMB consolidated all of the different links to where you can find additional program guidance and frequently asked questions and other resources. So that's at the start of the Compliance Supplement Addendum for all of the major programs. So in addition to the costs needing to be necessary, eligible costs must also not have been accounted for in the budget most recently approved as of March 27th, 2020. So what this means is that the cost has to be for a new cost or something not originally budgeted for, or the cost needs to be for a substantially different use, meaning that the original budget, the cost in the original budget were diverted for COVID-specific related items. And finally, to be considered eligible, the cost must have been incurred during the period that begins on March 1st, 2020 and ends on December 31st, 2021. Now, as Angie mentioned earlier, the president signed the bill on, I think it was December 27th. So at the end of December, he signed the bill, which effectively extended this period of performance by 1 year and 1 day from December 30th, 2020 to December 31st, 2021. We've updated this slide. There's going to be some slides coming up in a few minutes where we've cited the program guidance from Treasury or FAQs. And the last that I looked last night, that information hadn't been updated yet, but we do expect that additional guidance will be forthcoming from Treasury. So allowable costs can range from COVID-19 testing to personal protective equipment to payroll and other direct costs to assist, as well as assistance programs that are provided to organizations and individuals who have been affected by COVID. One type of cost that has generated a lot of discussion has related to capital outlays and equipment. So the expense of acquiring or improving property and equipment, such as vehicles, may be covered with the CRF funds in certain cases. But to be considered allowable, the government must be able to support that them acquiring or improving that equipment was more cost effective than leasing property or equipment. And that assessment must be documented by the government. Another allowable cost area where questions have come up is related to payroll. So payroll expenses for public safety, public health, human services, and similar employees whose services are substantially dedicated to mitigating or responding to COVID-19 are allowable. So with this, though, the government needs to maintain documentation to support how the substantially dedicated requirement was met. However, Treasury did provide as an administrative accommodation that a government may presume that their public health and public safety employees meet the substantially dedicated test. One thing that I want to point out specific to payroll expenses, though, is that the guidance is very clear that bonuses are an ineligible or unallowable expense. So if your organization did provide out bonuses to your employees, even if they met the substantially dedicated requirement, bonuses are not an allowable expense to be funded through the CRF funds. This FAQ here is just what I went over on the payroll side, so it's been included just as a resource for you. Another reporting requirement that's applicable to the CRF funds is for special reporting. Like I mentioned when I was going over the FFATA requirements, FFATA reporting does not apply to the CRF funding. However, there are special reports that need to happen. So each direct recipient must provide a quarterly financial report, progress report, to the Treasury's Office of Inspector General. And that report is to contain data such as the total amount of CRF funds that have been received, the amount of funds that were expended or obligated for each project or activity, and any information on loans issued, subawards granted, and direct payments made by the prime recipient that are greater than $50,000. With the exception of the first quarterly report that covered the period of March 1st through June 30th, 2020, the quarterly reports are due within 10 days after each quarter end. And if the quarter end falls on a weekend or holiday, you have until the next working day to submit that. Now, there was an exception for the first quarterly report because the reporting system was still in process. And that first quarterly report was due no later than September 21st, 2020. And that was for entities who selected the option to manually file all of their information in the grant solution portal. However, if there were any entities that elected to use the direct upload feature, that functionality wasn't available until December 1st. So those entities had additional time to complete the required reporting. Now, per the compliance supplement addendum, the reporting ends with either the calendar quarter after the COVID-19 related costs have been liquidated and paid, or the calendar quarter ending September 30th, 2021, whichever comes first. Now, again, with the bill that was recently passed and signed by the president, I'm assuming that this date will be pushed back a year, so just keep an eye out on that. Now, all of this reporting may seem easy enough, but it could be an area that's complicated to audit. So the reporting is made to Treasury OIG, which is different than just the Department of Treasury, and they use different terminology in the report. So as an example, something to watch for, Treasury OIG says that a payment to a governmental subrecipient should be referred to as a transfer, whereas under uniform guidance and everything that we're used to, it's just a subrecipient payment to us. So we just want to watch to make sure that all of the information on the reports is appropriate based on the guidance that Treasury OIG has put out. Just to give you a little bit of perspective, Treasury OIG has a separate set of FAQs, and there's over 80 questions on that. So that is going to be something that you're going to want to take a look at to make sure that you're familiar with. Now, the last requirement for CRF is the subrecipient monitoring. And there are no specific Part 4 requirements in the addendum for CRF. So it just refers the auditors to test subrecipient monitoring consistent with the general requirements in Part 3 of the compliance supplement. The main areas that auditors are going to be looking at are the pre-award requirements. So pre-award requirements would just be making sure that all of the required elements in the sub-award agreement are included. There also needs to be a risk assessment process that the entity does to determine the extent of monitoring that they're going to perform on the subrecipient. So the higher the risk a subrecipient is of not complying with the grant requirements, the more detailed monitoring that the entity needs to perform. We have included, just because of the limited time that we have with you today, we don't have a lot of time to go through all of the details of subrecipient monitoring, but we do have a link here for you to an article on specific to subrecipient monitoring. This here is just an FAQ on how to distinguish between if you're a subrecipient or a beneficiary. And essentially what it says is that for purposes of the single audit, any individual or organization, such as a business or a nonprofit, that are beneficiaries of an assistance program that was created under the CRF funds would not be considered a subrecipient, and they would be considered a beneficiary, and that the uniform guidance audit requirements do not apply. Now moving on to the Education Stabilization Fund. So this program is divided into several grants. As you'll see here, there's grants that are broken out by all of the alpha numbering. And so it's 84,425A through 84,425D. And all of these programs have a little bit different requirements, but what OMB has done in the compliance supplement is they have broken the supplement out into two different sections. So section 1 are going to be all of the grants that are governed by ESF, and then there's going to be a separate compliance supplement for section 2, which are the grants covered by higher ed or HEERF. And then you'll see that at the end of this, there's a third section for three additional programs with the subletters B and G. Those two programs are not subject to audit in the current year. And if anyone had expenditures under 84,425P, those programs are not, that program is not covered within section 1 or section 2 of the compliance supplement section for the Education Stabilization Fund. And so auditors will need to address that using Part 7 of the compliance requirement. So even though there's different compliance requirements depending on the specific grant received, for purposes of the major program determination, auditors need to consider all of the 84,425 grants as one program. So focusing first on all of the programs that fall into the ESF, or Education Stabilization Fund, Section 1, there's two programs that we're going to cover today. The first is the Governor's Emergency Education Relief. I may refer to this as just the Governor's Funds, or GER for short. These funds may be used for emergency support such as educational services and childcare. And these funds went to eligible entities, which included local education agencies, higher ed institutions, and other education-related entities. And that would be childcare centers, public libraries, non-public and for-profit elementary and secondary education schools. And with this funding, the governor determined the amount of funding that was going to go to the eligible entities based on need. The second set of funding in this bucket are the ESSER funds. And this is providing funding to state education agencies and local education agencies to address the impacts of COVID-19. So what happened here is the state education agencies received the funding, and they were required to subgrant out 90% of their allocation to all the local education agencies based on their share of Title I funding received. And then the LEAs were able to spend the funds in accordance with any covered purpose of the CARES Act. And so while the allowable use of the funds, again, is broad, organizations just need to make sure that they can demonstrate that the costs incurred were allowable and consistent with the purpose of the fund, which was to prevent and prepare and respond to COVID-19. So just to touch on some of the allowable costs quickly, for the ESSER funds, auditors are required to look and ensure that the entities spent the funding in accordance with the cost principles for states, local governments, and Indian tribes. So this is going to be consistent with the cost principles that you see in subpart E of the uniform guidance. For the governor's funds, the GER funds, those cost principles are a little differently. For those, you need to look at how the governor allocated those funds. So while both of these funds have similar purposes, the cost principles to follow are slightly different. So auditors and the auditees just need to be aware of that and make sure that the costs were getting charged to the appropriate buckets. Now, for both the ESSER and the governor's funds, specific to payroll, recipients will not need to maintain time and effort reporting if an employee's time, 100% of their time is charged to the grant. So if an employee charges 100% of their time to the GER funds, as an example, that time and effort documentation is not needed. However, if an employee splits their time between multiple grants, or if only part of their time is charged to the grant, that time and effort reporting is going to be required. Lastly, this slide lists the other compliance requirements that are applicable to these ESF funds that are included as part of the Section 1. Cash management, subrecipient monitoring are all going to follow the Part 3 general requirements. The same with reporting. So reporting, the entity must follow those new FFATA reporting requirements that were added to Part 3. Now for those ESSER funds, there is an earmarking requirement to make sure that at the state education agency level, that the SEA was allocating out at least 90% of the funds that they received to those LEAs. And there is a requirement to test that the SEA did not spend more than 0.5% on administrative costs. The equipment and real property management, you're also required to follow Part 3 general requirements, but there is an additional requirement that auditors are going to be required to test that any capital expenditures charged to the grant were, they're going to need to verify that there was prior approval for those costs. With that, that was a quick rundown of part of those programs. I'm going to hand it over to Joy to wrap us up.
Okay, thanks, Sarah. I'm going to continue our discussion here today on the Education Stabilization Fund and cover the Higher Education Emergency Relief Fund, or HEERF, as Sarah referred to before, with a focus on letter E, which is the student portion, and the institutional portion, which is letter F, since the majority of the institutions receive this funding. The funding was distributed based on a student enrollment formula, and each institution is required to complete the certification and agreement for both the student aid portion and the institutional portion. And again, this was part of the CARES Act that was passed in March of 21. You need to pay close attention to the timing of when you are signing the date of the certification and the agreement, as this may affect your revenue recognition and your SEFA presentation. If you are a June 30 year end, for example, and you sign the HEERF institutional piece in July, even though you incurred expenditures prior to June, you didn't necessarily have an award in place until your fiscal year 21. So in this case, the HEERF funding for the institutional portion would show up on your fiscal year 21 SEFA. Okay, then we'll move on to the student aid portion. So the institutions are given 1 calendar year from the date of their grant award notification to spend the allocation. 50% of the allocation must be spent on the students. So that is a minimum requirement. And only those students who could be eligible to participate in Title IV are eligible to receive funding from the student aid portion. They also may not be paid to students that are enrolled exclusively in online programs prior to March 13th. And they must be spent on funds, on expenses related to the disruption of campus operations. So kind of the obvious things when you're a student living on campus: food, housing, course materials, technology, etc. What will your auditors be looking for relating to the student portion? We are going to be reviewing that the institution had a documented plan to distribute the funds to the students, that the institution did not place any restrictions on the expenditures beyond those listed in the statute, and that the institution expended the entire amount of the student aid portion on grants to students and did not retain or reimburse themselves for costs of expenses that were previously issued to students. So if you had dispersed money to your students prior to receiving this funding, you cannot reimburse yourself under the student aid portion for those previously distributed funds. As far as the student aid portion, there is some required reporting that needs to be posted on the institution's website. They've kind of changed the timing of when that information needed to be available on your website. There was an initial 30-day period, and then switched to 45, and it's currently at quarterly reporting requirement. And as it relates to the student portion of reporting, auditors are going to be required to test key line items, and they are listed out in the compliance addendum, and will need to verify to the underlying supporting documentation. So make sure you're retaining your support for anything that you are reporting on your website. We will also be required to test for timely reporting. So again, if you can retain some documentation either from your IT department or other method of indicating when that information was uploaded to your website, the auditors will be needing to look at that. Also remember to document your oversight and secondary review process, indicating that you have sufficient controls in place. Okay, moving on to the institutional portion. Institutions are also given 1 calendar year from the date of their grant award notification to spend the institutional portion. So obviously, if 50% is the minimum on the student portion, no more than 50% must be spent on the institutional portion. However, the institution can elect to make additional grants to the students with the institutional funds. The funds must be used to cover any costs associated with significant changes to delivery of instruction, as long as the costs do not include payments to contractors for the following things. So there's a list on the slide here of some unallowable costs. I wanted to mention that the costs that were incurred prior to the award date, but after the declaration of the national emergency, which was March 13th, can be claimed. So they are allowing pre-award costs to be submitted under the institutional portion. Similar to the student portion, there are separate reporting requirements for the institutional portion. There's a quarterly budget and expenditure report that's required to be posted 10 days after each calendar quarter year end. And then I understand that effective today, the annual report data collection tool is open through February 1. The submissions are required to be completed by February 1. They've indicated that they are not granting any extensions or accepting any late submissions. Also, as it relates to the 50-50 division between the students and the institutional portion, that will be measured at the end of the period of performance. So you don't need to be concerned about spending the student and institutional portion pro rata. We're also aware that the December 27th bill that the president signed provided additional HEERF funding. We do need additional Department of Ed guidance relating to this. The method in which those funds were distributed, the formula is a little different. The student eligibility piece is also a little more flexible. The 50% minimum to the students still applies, and it does sound like they are expanding the allowable uses. There's mention of lost revenue in the new bill. So more clarification relating to the additional round of funding under HEERF. The last source of funding that we're going to cover today is the provider relief funds. And this was the funding that was provided to providers of healthcare and was intended to give those providers support for healthcare related expenses and this concept of lost revenue. There've been lots of changes in direction as it relates to this funding source in particular throughout the course of 2020. And also the concept of lost revenue or reimbursement for lost revenue is a new concept as it relates to single audits. So I'm going to be touching on lost revenue briefly here in a bit. There were several rounds of funding, both general and targeted distributions. There were various formulas used. In many cases, the funding just showed up in your bank account and you didn't have to apply for it. In some cases, you had to apply, but it was very difficult to maybe determine if you received what you were entitled to receive or what you had asked for in your application. Similar to the other funding sources, the recipient must certify to the terms and conditions. There are separate activities allowed criteria in the addendum for the skilled nursing facility infection control distribution versus all other distributions. So I'm going to refer you to the compliance addendum for that guidance. The auditors will be testing what those funds were used for. There's not a lot of guidance included in the compliance addendum that is new, other than what has been previously communicated in frequently asked questions. So I think there's some judgment involved. Remember again to have your oversight and review process over the identified costs documented. And that level of documentation needs to be such that if HHS OIG reviews your program, the determination of what costs are being claimed under the various funding sources, because in the healthcare arena, there's lots of different funding sources. You need to make sure you are tracking which funding source you're claiming which expenses to ensure that you're not claiming the same expense under multiple funding sources. They are allowing both general and administrative expenses and healthcare related expenses. So again, referring you to the frequently asked questions. There are separate audit requirements for the for-profit healthcare providers. There's lots of uncertainty relating to the options that have been provided to the for-profit providers. So we are hoping and expecting for further guidance or clarification as it relates to the for-profit providers. As it relates to allowable costs, moving on to the next slide, they did give us some indication if you're debating whether an expense is allowable, you should ask yourself these two things. Is the expense necessary and reasonable to support patient care efforts? And is the expense incurred consistent with your organizational policies and procedures? So I think what this is getting at is there should be some kind of level of fiduciary responsibility placed on the healthcare providers and how they are determining which expenses are reasonable and necessary and spending those funds appropriately. Moving on to the next slide, the guidance also does indicate that you must report actual expenses incurred over and above what has been reimbursed by other sources. So this is where some of the complexity comes in because of the various provider sources or provider payers in the healthcare area. The frequently asked questions do walk you through various reimbursement examples by payer sources. And it also indicates that you can request reimbursement or submit reimbursement for marginal increased expenses. So there are examples of what incremental PPE supplies costs might look like as well. The next frequently asked question also addresses the cost-based reimbursement. So if you are a healthcare provider that under Medicare reimbursement gets certain costs reimbursed based on the costs that you incur, this FAQ makes it pretty clear that you can, if you are getting full reimbursement for those costs by Medicare, none of those costs would be eligible. And if you're getting partial reimbursement, you would only be able to submit the amount that isn't being reimbursed by Medicare. So it's clear that there's going to be some significant estimates involved relating to this piece of the requirements. We expect it to be an estimate, probably likely using cost to charge ratios. We recommend working with your reimbursement specialists to determine the best way to reduce the eligible cost by anything that's being reimbursed. The next slide is a piece right out of the compliance addendum. And what they're trying to do with this is address the fact that they're acknowledging that the guidance has continued to change throughout 2020. And so if perhaps your entity has made decisions based on prior guidance, which is now not appropriate, if you have documentation in place that you are following the guidance at the time of the transaction to support why you made the decision you made at the time, this is basically a key provision. It's going to be a little challenging from an auditor perspective on how we are going to audit a moving target and document that in the single audit, both our documentation and in the report. But I wanted to point your attention to that. Okay, we'll move on to the HHS reporting requirements. So the most recent version of the reporting requirements was issued in November of 2020. The recipients that received less than 10,000 and various recipients listed here under some of the targeted distributions are not subject to the reporting requirements. The first piece of the reporting requirements are the expenses. And so the recipients of the PRF funds need to report expenses that aren't reimbursed by other sources. Both direct patient care and overhead activities will need to be reported. And again, they are allowing both G&A overhead and healthcare specific operating expenses. So in addition to the expenses, the report also has a lost revenue report on the next slide. So that concept of lost revenue, I'm just going to spend a little time on that here. Recipients may apply provider relief payments towards lost revenue in the amount of the difference between your 2019 and 2020 patient care revenue. This is calculated on a calendar year basis, no matter what your fiscal year end is. And then for the first half, or the first 6 months of first 6 months of 2021, that's going to be compared to the same period in 2019. So that's not a typo, it's going to be a 2-year look back the way the compliance addendum is currently worded. You also will need to consider other assistance received that will be reported as operating revenue when you're doing this year-over-year comparison. We are aware that the bill signed on December 27th changed the permissible method of lost revenue calculation again, essentially reverting back to the June 2020 FAQ guidance, which allowed the use of the comparison to budget rather than comparison to actual. And that is assuming that the budget was approved by March 27th of 2020. So lots of unknowns here again. We're not sure if that lost revenue calculation compared to budget can be done on a monthly or a quarterly basis, or if they are going to also require the budget comparison to be on an annual basis as well. We're not sure if the budget to actual comparison will be available for the first 6 months of 2021. Okay, so we're not sure if that budget to actual comparison will be available for the first half of 2021. Obviously, HHS will need to update the FAQs and the November 2020 reporting requirements to address this change, since it's currently inconsistent with the reporting requirements from November. In addition to the lost revenue, there will be some additional requirements on the next slide. Those are listed. You need to remember to maintain your support because the auditors will be required to look at this as well. Those requirements consist of net revenue by payer type and certain metrics. Okay. Going on to the next slide, the timeline for the reporting guidance is a pretty quick timeline. The deadline is the use of the funds need to be by June 30 of 2021. And the first report on the 2020 data is due February 15. The report for January through June of 2021 is due July 31 of 2021. So we acknowledge that this is a pretty quick turnaround. We would potentially anticipate there to be an extension to this deadline, given the new guidance. Okay, this slide is a key slide, and it relates to the timing of when you report your provider relief fund on your SEFA. And so essentially what this slide is saying is that you would report on your SEFA if you are a calendar year end. You would report whatever you reported on your February 15th HHS report on your SEFA. So there's a connection between the February 15th report and what you're going to show on your SEFA. If you have a fiscal year end before December 31 of 2020, you're not going to include any provider relief funds on your SEFA. And if you have a fiscal year end of June 30, 2021 or later, we are expecting additional guidance to be coming out. Okay, because of this tie-in between the February 15th report and the SEFA, the accuracy of the report is more important than ever. So moving on to the next slide. You know, this report is going to be used to determine the amounts that are being claimed under the program. It's likely going to be a basis for determining whether a program audit or a single audit is required. And it might be a basis for subsequent audits by OIG or HHS. So in addition to those criteria, the auditors are required to express an opinion on the reporting that you're doing, both on the February 15th report and the July 31 report. And so if you are not getting those reports correct, you will automatically have a single audit finding relating to the compliance reporting requirement. And then as well as, because whatever you report on the February 15th report will also be on your SEFA, since the SEFA or Schedule of Expenditures is a financial statement, you would automatically have a financial statement finding as well. So we can't emphasize the reporting of this enough. Okay, enough on provider relief funds. Looks like we're running short on time here, so let's move on quickly. We'll try to hit a few other single audit requirements. The extended due dates for recipients. This slide is some good news. If you are a recipient or subrecipient that received COVID-19 funding, With the original due date from July 31 of 2020 through June 30 of 2021, you are being granted a 3-month extension beyond the normal due date to get your single audit reporting package done and submitted. This only applies if you've received COVID-19 funding. There's no extensions if you have not received any COVID-19 funding. It doesn't require agency pre-approval. However, it does indicate that recipients and subrecipients should maintain documentation for the reason for the delayed filing. We acknowledge that the SEFA, moving on to the next slide, is going to be more challenging. This is a visual of what your audit extensions would look like. So for example, if you have a March 31 fiscal year end, the normal due date is December 31 or 9 months after your fiscal year end, which is with the 3-month extension, that gives you a full year to get your single audit done. The SEFA presentation, again, is going to be more challenging for those of you that prepare your own SEFA. It will likely look very different from the prior year. You have many funding sources to consider. I touched on this previously. You should include the information or the award on the SEFA when both the underlying activity or the expenditure occurs and there is an award or grant terms in place. So there's likely going to be mismatches between when you incurred the costs and when you report it, or when the award was actually received. So as auditors or accountants, we like to have our SEFA match our grant, our financial statement and our SEFA kind of be similar. In this case, or this year, or for the next couple years, it's not going to be the same. And so not necessarily the same as GAAP revenue recognition. Okay, we have a SEFA example here. If you have COVID-19 funding, it should be on a separate line. This does apply to both new and existing programs. So we have an example for you to visualize what the requirement might look like. If you don't want to use the prefix, you have to choose some kind of other identifying method. You may want to add a SEFA disclosure if there are SEFA versus GAAP differences that you can help the users of the financial statement understand the timing differences. Okay, I think one more slide, donated PPE. This is also in the compliance addendum. It indicates that entities that receive donated PPE should report the fair market value at the time of the receipt in a standalone footnote to the SEFA. So this will likely be an estimate unless the entity, the federal agency, has provided the dollar amount to you. It is not going to be counted for purposes of determining whether you have or have not met the single audit threshold, or for determining which major programs your auditors would be testing. It does indicate that the PPE footnote will be marked unaudited by the auditors. Just from an auditor perspective, it will be very difficult for the auditors to know if that disclosure is complete and the recipient has actually captured and reported all of the donated PPE. Okay, and with that, I will turn it over to Angie to get us wrapped up. I apologize for the interruptions and the delays.
All right, thanks, Joy. I think given that we're running a couple minutes over, just take a look at this last slide at your leisure. It provides some additional information on the uniform guidance changes that you'll want to be sure that you're aware of as you move forward through the rest of the year. And with that, I want to thank everyone for joining us today. Also wanted to acknowledge that there's a lot of questions in the chat that we are unable to get to, but stay tuned for further webinars that we'll put on that will be a little bit more specific to some of the various types of awards that we talked about today. Thank you, everybody.
All right.
Have a great day.